You want to perform a monthly bank reconciliation to make sure that you're capturing all of your expenses and all of your income, but also that you're not double counting anything or excluding anything. Welcome to the Know Your Worth show, where we teach you how to think about your money differently so that you can achieve your sexy money goals. I'm Sydney, your money maven and owner of Know Your Worth.
And I'm Kristen, Sid's dime piece bestie, team member, and busy mama twins, here to make sure that those of us without a financial degree can still level up with each episode. Let's get started on reaching your next goal.
Hello, welcome to the Know Your Worth podcast. I am one of your hosts, Sydney Conway, your money maven.
And I am Sid's dime piece bestie and assistant, Kristen.
Welcome to episode 25. Yes, 25 episodes.
I know.
I'm so
done
proud
anything
of us.
25 times.
I'm so excited. We've kept it together.
Thriving.
In today's episode, we are going to talk about bank reconciliations in your QuickBooks account mainly, but you can do bank reconciliations in any accounting software, and you should do bank reconciliations monthly.
All right. Tell me about it, because I don't know what you're talking about. I sort of do.
Yeah. Well, that's what we're here for. Bank reconciliations should be performed, or just reconciliations. It doesn't necessarily need to be the bank account. It can be the money market account, any other savings accounts, credit card accounts, really anything on your balance sheet you can perform a reconciliation for.
Mm-hmm.
And I would recommend doing reconciliations for the balance sheet accounts once a year, but specifically for the bank accounts and credit card accounts every month.
Can you tell me what that means?
If you're someone that connects your bank account to your QuickBooks, every day transactions flow through your bank account into your QuickBooks account, and you categorize those accounts based off of what the transactions are for, and then they're reported on your financial statements. Your bank balance, because it's connected to your bank from QuickBooks, is a live bank balance based off of that connection. The reconciliation at the end of the month compares the official bank statement from your bank to what's in QuickBooks and what's in your accounting software.
Okay.
So you want to perform a monthly bank reconciliation to make sure that you're capturing all of your expenses and all of your income, but also that you're not double counting anything or excluding anything. You just want to make sure everything is there and that it all is accurate.
Gotcha.
That's the bank reconciliation. Same thing goes for the credit card reconciliation. Same thing goes for any kind of reconciliation. You're making sure that you're capturing everything that's there. Things are not there that shouldn't be there. And you're cleaning it up based off of the record that comes from the bank, that comes from the credit card company, that comes from the debt financing firm, that comes from the insurance company. Any of those that would show your balance as of that date, you can reconcile the account to match that balance.
Gotcha. So whenever you do a QuickBooks cleanup, you go back over an extended period of time and you just start reconciling from when the person dipped out to present day.
Yes.
Fun.
Yeah, it's super fun. And we have definitely experienced some doozies in the reconciliations.
I want to know one without giving too much information.
Oh, yeah. I mean, there's quite a bit. So one recent one that we just had happen was a client that said they reconciled every month. That, hey, I reconcile this account every single month. It's completely correct. Well, when we go into QuickBooks, we can see that there's no record of reconciliation. And QuickBooks will tell us kind of the audit trail that says everything's been reconciled. So we came back to this person and said, it says that you've never reconciled. And they're like, well, no, I did it outside of QuickBooks. Or I would take the statement and I would compare every transaction and make sure they're all there. Well, that's great. That's a really good move. But your bank balance is not matching your QuickBooks bank balance. So something is off somewhere.
Right.
Have you ever checked into that? They're like, well, no, because every month all the transactions are there. Great. So that means going forward month to month, they're probably fine. But the beginning balance was wrong.
Yeah.
Because what happens in QuickBooks is when you connect the bank account, say you had $1,000 in your bank account when you connected it to QuickBooks. You might bring in those transactions from QuickBooks that show that $1,000 deposit, but the day that the account is connected to QuickBooks, QuickBooks shows that beginning $1,000 as the starting balance.
Okay.
So it double counts it right away. So you want to make sure that you almost remove or delete that beginning balance from there. And it also shows up as automatically reconciled because it says it's coming from the bank. And so that's where like QuickBooks isn't wrong, but it's not correct if you're bringing in historical information.
Gotcha.
So this client probably years and years ago never corrected that.
Gotcha.
So when they've been
They're
turning
just
in their financial
carrying it.
statements, their bank balance was wrong.
Oh, man.
And that's not necessarily going to impact your taxes if you're a cash-based tax filer, because his income and expenses were correct, because that beginning balance goes into equity, which doesn't impact your taxes right away at a very surface level approach. It won't impact your tax filing for that year because the ins and outs of the company, it doesn't affect that. It almost looks like it's a contribution into the company. Again,
Gotcha.
We're not going to get too deep into that today.
Okay, following.
So it might not have affected him for the past couple years. It could have been maybe the very first year it impacted him, minuscule amounts, but it just was never correct. But what it can impact is if you're going to apply for a loan or you're going to get financing for anything, a line of credit, and a financer or an investor is looking at your balance sheet and your cash balance is incorrect, it could be showing really high cash balance or really low cash balance. And it just needs to be accurate at that point. So this client carried forward an incorrect balance on their balance sheet for their cash for a long time. So we made a journal entry that just brought it back down to the balance.
Is that how easy it is? Just
Yeah. You want to dig in to find out where it is and make sure that you're impacting the correct accounts. But yeah, to make the correction, it's just sometimes it can affect your taxes then. If you filed incorrectly in previous years, you might then have to correct it for this year or you amend previous years.
Just another reason to have a bookkeeper.
Yeah, there's bank reconciliations are important.
1,520.
Bank reconciliations are important. Credit card reconciliations are the same thing. You want to make sure everything is there. The toughest ones that we've seen with bank reconciliations are Chase credit card accounts. If you have a Chase credit card or you have multiple Chase credit cards, they are very complicated in that all of these separate credit cards need to be connected to QuickBooks. But when you reconcile them, you have to create a parent account and reconcile the parent account. You can't reconcile each card individually because when you make a payment, it doesn't apply to each card individually. It applies to the whole account.
Gotcha.
So we have to create a parent account in clients' books and reconcile the parent account.
Wow.
Rather than each individual card. But in QuickBooks, each individual card has to be connected. You can't connect a control account, where in PNC, there's a control account that's connected. So even if you have 10 cards, you only need to connect the one control account.
Yeah.
But Chase, you have to connect each individual card, but then none of the payments show up on those.
So you have to create like the hub.
Mm-hmm.
Jeez.
Yeah.
It's an anti-Chase commercial. I'm just kidding. I don't know what I'm talking about, guys.
That's the beginning parts of the reconciliations.
Okay.
One of the other big red flags that we have seen is when clients create journal entries and they don't know exactly what they're impacting, or they carry forward unreconciled transactions because they don't know what they are.
Okay.
So when you go into QuickBooks, you can go to the account and you can click reconcile on the account and it pops up all the transactions for the time period you're looking at, which should be month to month. But sometimes people wait to the end of the quarter. They do it quarterly or they do it yearly. So what you're typically doing in QuickBooks is you're putting in the ending balance. The beginning balance is already in there. And so it's from this balance to this balance, all the transactions that are included. So you're basically replicating your bank statement.
Okay.
So you're selecting every transaction that shows up on your bank statement in the QuickBooks reconciliation tab.
Check, check, and check.
And then once it zeroes and it's green, you click complete and you're done and you've reconciled. But if there are items that are in that account that you're not checking, but they're showing up there, well, they're showing up there because you've made an entry that impacts that account balance.
Okay.
So if you're just like, well, it's not on the statement, so I'm not going to click it, you don't click it then, but it's still impacting that balance in the account. Just because you've reconciled it
doesn't mean it goes away.
Doesn't mean it goes away.
Yeah.
So what we see a lot of that is, say, QuickBooks disconnects from the bank and reconnects from the bank and duplicate transactions come in. So it might only happen for a couple days. When we go to reconcile, say we see 2 Adobe charges for $12. We see 2 gas station charges for $20. And we see these duplicate charges. What we've seen in the past is people will select only one of them because they know that they're duplicates. And then they reconcile and say, great, I did it. But they'll leave those duplicates in there.
What do? You delete them.
We need to delete them. You need to exclude them because they are duplicates. They're not supposed to be in there.
Yeah.
But if you let them go for a year like that, you've then filed your taxes and you've recognized 2 software expenses, 2 gas, and 2 things because you haven't cleared them out or deleted them.
Right.
So your bank reconciliation is another check and it catches just to make sure every expense is in there.
Yeah.
You're not missing anything, but then also you're not double counting anything too.
Yeah.
Payroll is a big one that we see happen a lot, where payroll entries for clients that have their payroll connected to QuickBooks, if they don't match them appropriately, they both come out of the account. And so it's almost like a duplicate entry there. And payroll ones are hard to fix because they're connected in QuickBooks. So I don't love QuickBooks payroll. And so when we see mistakes in the reconciliation based off of the payroll, it's a little stickier. So we have to make a journal entry. You don't just delete the entry because it's connected to all of the background information.
Right.
So you don't want to delete it. You have to make an adjusting journal entry for it.
Jeez.
Yeah.
How do you do your job? It's like playing Jenga.
It's a puzzle. Yeah. It's puzzles. If you like puzzles, you'd like bookkeeping. I love puzzles. When I see that green check mark, I'm like, oh, I did it.
Like I did it. Yeah.
But what I would recommend doing too, if you're someone that's trying to reconcile your accounts and you're really having a tough time, print out your bank statement and get a highlighter. Uncheck everything in QuickBooks. When you see the transaction in your bank statement, highlight it and check it in QuickBooks. Go to the next one, highlight it, check it. And then you'll see, are you double counting or are you missing something in QuickBooks? Or you're looking at your bank statement, you see a transaction that you didn't highlight, it's missing from QuickBooks. So then you need to add it manually.
Yeah.
Or did it double count because you have it checked in QuickBooks, but it's not on the bank statement? That's one of the times where when things do get complex, I do need to have that like physical printout and go through line by line.
Wow.
A lot of the times it's not like that if we're maintaining things, but for some of the new clients that we get or the cleanups, we have to do pretty manual like processes like that.
Okay.
Yeah. So if you've never reconciled your books, I would definitely recommend it. The other things that you can reconcile are everything on your balance sheet, your fixed assets, your prepaid expenses. And when you get into larger companies, that's where you're going to see like prepaid expenses, and not necessarily larger. You can do prepaid expenses or deferred revenue or anything as a small company too. Sometimes it's just not worth your time so much. So when I say prepaid expenses, when you pay for your insurance for the year, it's a time period. So if your prepaid expenses, if your insurance expense that you purchased doesn't go from January 1st to December 31st, what it is you're paying for the whole year. But really, it should be like a month-to-month breakout.
Okay.
So at the end of the year, it would all clear out. So you don't really have to have a prepaid expense account because at 12/31, you don't have insurance anymore and it starts again 1/1.
Yeah.
If you're somebody that say you buy insurance in April, and it's a year policy, what the technical accounting, the GAAP accounting that you would want to do for that, that's the generally accepted accounting principles. Your GAAP accounting is the correct method.
We talked about that before, didn't we?
Yep. Nice little refresher there. You would book that insurance to prepaid expenses. And so cash would go down, prepaid expenses would go up. Then every month you would amortize that balance. So prepaid expenses would go down and insurance expense on the income statement would go up.
Okay.
So you only recognize the expense in the month that it technically is being used.
Then by the end of the year,
it's zero. Exactly. But at the end of the year at 12/31, you might have that little bit left over for January, February, March because the policy renews in April.
Okay.
So at the end of the year, you want to make sure that that prepaid expense account is accurate. So you would reconcile that account and you would say, okay, I bought the policy. I have a journal entry that's clearing out the balance every month. And so then at the end of the year, I should have this balance left. And so you would reconcile to make sure that's correct. And you would say, yes, it is. If it's not, you would make a journal entry to correct the prepaid expense balance, increase the insurance expense on the income statement. When we say you can reconcile every balance sheet account, that's how you would do different ones that aren't necessarily bank accounts or credit cards.
Interesting.
Wow. The red flag that we see with a lot of clients is that a lot of business owners that aren't savvy with there's nothing wrong with that, but it's just, this is one of the things to be aware of. If you have balance sheet accounts that are growing and you don't know why, or they're growing and they shouldn't be, you want to reconcile those accounts to make sure that you're not putting something there that shouldn't be there.
Or having duplicates.
Yes.
Yeah.
So one of the things that we would typically see is that things would be booked incorrectly. One of the main accounts that we see that was fixed assets. So if a client purchases something big, like a car, if they buy a car for the business, they try to write it all off in the first year. They just think, oh, it's travel expense or it's car and auto expense, and it would be on the income statement. That car should be added as a fixed asset, and then it would need to be depreciated every year. Not your car payment. It's the value of the car.
How do you figure that out?
Say you don't have a loan on the car. You bought it cash, $20,000, used car, whatever it is, new car, whatever it is. You paid $20,000 from your business for a car. So you don't have a loan payment. You don't have any of that, but the car is owned by the business. Instead of that $20,000 being an expense, it would become an asset. And then every year you would depreciate, or every month, but typically we would true it up every year for if you're not being audited or something like you don't want to see monthly statements like that. You would true it up every year for the depreciation entry. So the useful life of the car is so many years. All fixed assets have different useful lives.
Okay.
They're all different for whatever.
Is there like a book somewhere?
Yeah, there's a book somewhere for sure. It's the study materials for the CPA test or just Google. But a lot of things vary. If it's typically you'd see 3 years, 5 years, 7 years. Buildings are 40 years, things like that. A vehicle, and honestly, I'd have to look to make sure I had the timeline right for that. But let's just say the vehicle is 7 years. You would take that $20,000 and you would divide it by 7.
Okay.
So every year, the value would go down by that 1/7 of that price. So that's where every year you are reducing that balance sheet account. What you need to make sure then is at the end of every year, you are correctly reconciling that account. What we would see sometimes is that then with that fixed asset account, people are sometimes not sure where it goes.
Okay.
So they're putting really small purchases into fixed assets. And they just would see it grow. And it should either be depreciated or they might not even need to be there to begin with.
Okay.
Another big one we'd see that with is inventory. If you're a client that has inventory or you're a business that has inventory and you're buying inventory for your shop, but you never do an inventory count, that balance might be completely inaccurate. So if you need to count all the inventory in your shop or your store, you would then reconcile that inventory balance and true it up to what it actually is.
Okay.
Did it get stolen? Was it damaged? Was it gifted to somebody? Did you buy more and not record it? What is that balance and what should it be? And do you either write some of it off or do you true it up and you would make a journal entry based off of kind of whatever way it went then?
How does anybody know how to do this without a bookkeeper? Everyone's just winging it.
They need to be a very good Googler, or if their tax accountant helps them with a lot of things. But a lot of times tax accountants just don't have the time to look at it at the end of the year.
Yeah.
So it really does help to have bookkeepers for a lot of this stuff.
I mean,
it's a lot. It's a lot to think about. Yeah.
Just when you think you have it, it's, oh, no, wait, you bought a car and now all this math.
And I will say for a lot of business owners that don't have, accounting departments and they're just flying by the seat of their pants, right? Or flying by willy-nilly. Exactly. If you go out and get a car for your business, you're most likely going to talk to your tax accountant at the end of the year and they'll give you the entry for depreciation. And they might not even tell you what the entry is. They're just going to true it up in their books.
Okay.
And then you're not going to know. And then the next year they'll file the taxes and they'll do it again.
Yeah.
And you just don't have it updated. And that might be right and correct for tax purposes. But then if you're looking at your own books and you're saying, what am I missing? It might be because your tax accountant is making journal entries correctly, but then they're not being reflected in your books.
Yeah.
There is a lot that goes on between you and your tax accountant at the end of the year that might not get back to your financial statements that you want it to come back to your financial statements. So if you're somebody that has fixed assets and you've never booked a depreciation entry, ask your tax accountant for the depreciation entries that they've booked and then book those into your accounts.
Okay. And then hand those to your new bookkeeper.
Yeah, exactly. Exactly. We can do that for you for sure. We do that for a lot of our clients. We get the journal entries from their tax accountants and we make them in the books. Another big one is payroll reconciliations. At the end of every year, you might have accrued payroll in there for wages that were earned but not paid yet. So you need to true up that balance. Again, a lot of the time though, if you're filing your taxes cash basis, it's not going to be the biggest issue. for some of them.
Mm-hmm.
But for others, you really want to make sure that you have those balances trued up.
Okay.
Yeah. It's a lot. It's not as intense as it sounds here for, I'd say most of
I don't believe you.
Most of our clients with the journal entries and with the reconciliations for the other balance sheet accounts, we would do their bank reconciliations and their credit card reconciliations every month.
Mm-hmm.
Then at the end of the year, we would true up the loans and debt accounts. So were they paying payment to a loan, and then we'll true up the interest and make sure that the principal payment is accurate. And then the interest is reflected. So if they're paying $1,000 a month to a loan, we would say, oh, okay, actually 50% of that went to the loan balance, but 50% of that payment was interest.
Okay.
But throughout the year, you're just booking it all to the loan. Well, then at the end of the year, the report that comes from the bank that says, actually, it's this, we would make sure that it's trued up to show that balance, and then interest would be reflected the other way.
Okay.
That's the typical adjustments that we would see. After that, we see different entries with much larger clients then that have a lot more complex bookkeeping.
I always just want to be like, you're the smartest person I know.
No, I'm not. I'm not.
I don't know.
Nope.
I don't know. It's a toss up, man.
Nope. But I can help with bookkeeping if anybody needs it.
All right. Info at knowyourworthpgh.com.
Yes. Reconcile those accounts.
Yeah.
If you don't have them done, you can check in QuickBooks to see if they've ever been done. It's a good check for your bookkeepers too, is to check and see that they're reconciling, because we've gotten a lot of clients that it's in their previous bookkeeper's contract and it's not done. Check to see when your bookkeeper is reconciling your books. And if it's not something that they're doing, it's something they should be doing. It really is, to make sure that everything is there. Yeah. Get your books reconciled. Come see us if you need it.
We'll be here. See you next week.
Absolutely. Have a great rest of your day. If you found a bit of inspiration in this episode for achieving your sexy money goals, click the subscribe button on your favorite podcast app or YouTube so that you never miss an episode.